Lord King, thank you for being here. We really appreciate it. This is your second time, you were telling me, in Texas?
Second time, and it's wonderful to be here because most of my experience of the US has been in the Northeast.
Right.
And yet the warmth of the hospitality I've received in the 6 hours I've been here already. And I am overwhelmed by the airport. I assumed that American airports were all like JFK and LaGuardia. But I'm delighted to say they aren't.
Yeah.
It's the best airport I've seen in years.
All right, that's good. Interesting. So you and I were talking, and I'll start with this. Why did you become, or how did you become a central banker?
By accident. I was an academic, and I taught in the States, went back to London, to the London School of Economics, and I was asked to be a non-executive director of the bank, which is a little part-time position at the Bank of England, and I took that on. And after 6 months, the then chief economist decided to leave and move on to something else. So the governor at the time, Robin Lee Pemberton, had to appoint a successor. And he said, do I really have to have an economist? He wasn't very enthusiastic about having it. And in the light of subsequent events, you can see why. And but he was told he had to have one. So he then thought very hard. And at the bank, there was a family sports day once a year. And as a non-executive director, I've been invited to play in the governor's tennis match. And it was the best performance I had ever put on court to that date, and indeed, I regret to say, subsequently. I hit the ball really hard, and the ground shots went in. So he was so impressed, and he knew I could play cricket as well. So he thought, well, if I have to have an economist, can I have one who can play cricket and tennis? So that's how I was offered the job, and I had no intention of staying. I took it for 2 to 3 years. And, with every intention of going back to academic life. But each time I tried to go back, something happened. So the first time we left the exchange rate mechanism when we were forced out, and I came up with the idea of the inflation target. And then I was about to leave again when the Bank of England was made independent. And
just for the audience, what year was that?
So we introduced the inflation target in the beginning of 1993, after the exchange rate mechanism debacle of 92. 1997, the incoming Labour government made the Bank of England independent, and I had to stay on to make that work. And then
independence in that context meant what?
Meant deciding interest rates. Up until that point, the level of interest rates had been decided by the Chancellor of the Exchequer. And in fact, we didn't even have regular meetings. You could sit in your office in the morning and get a telephone call saying the Chancellor would like to discuss interest rates after lunch. And so the financial markets had no idea when interest rates could change. Could change at any moment on any day. Except, of course, when there was a by-election or there was some political event where it would be inconvenient to change interest rates. And that completely altered in 97, so much so that when Tony Blair stood down as Prime Minister, it so happened, and no one has commented on this because independence of the Bank of England was accepted so readily, his announcement that he was standing down as Prime Minister coincided to the very minute with an announcement that we were raising interest rates. That could never have happened under the previous regime.
Yeah.
So each time I was, then I was asked to be governor, so I had to stay on for that. Then I was going to leave after my first term, but we're bang in the middle of the financial crisis.
Right.
But come 2013, it would have needed an act of Parliament to change the maximum length of a term, and that was too much for anyone. So I was able at last to leave.
All right. So let me ask, because you mentioned we got into it earlier. What's the importance of a central bank being independent? We're having a lot of conversations in this country about central bank independence. Why is it important? What difference did it make in the UK to become independent?
So I think it's quite an interesting contrast between then and now. So then, when we were made independent, it was not so long after the 2 decades of very high and volatile inflation in the 70s and 80s. Even here in the States, inflation reached 13.5%. In the UK, it reached 27%. But it was all over the place. And that led to volatility, not just of inflation, but of output and employment too. So we were very keen to get away from that. And the way to achieve it was a combination of taking the decision on interest rates away from political influence, giving it to a central bank that genuinely had independence, and secondly, introducing an inflation target either overtly or implicitly, in which the central bank would bring inflation gradually back to the target. And everyone knew that, so expectations of what would happen in the future were anchored to confidence in how the central bank would behave. And I think that was very important. What is fascinating today, of course, is that at the very moment when central banks are keeping interest rates very low, the politicians around the world are complaining that they're too low. This is the reverse of what we had assumed would be the case. But I do think that we shouldn't allow, if we become too obsessed by the current circumstances we face, the risk is that if we abandon independence of central banks, we'll throw out the baby with the bathwater, and another decade on, we'll find ourselves with high inflation again, and then wonder how can we get it back. And of course, the one thing we learned about inflation was that once you've let inflation rise to too high a level, it's very costly to bring it back. You need a deep recession to bring expectations of inflation back down again.
So you were the governor during the lead up to the crisis and during the crisis. What are the key lessons you learned in the aftermath of the crisis?
Well, there were many of them, I think. The first and biggest, and the one I talk about in my book, is that I think having created this remarkable period of stability of inflation and output, we rather got carried away and forgot the basic rule, which is you can never forecast the future. The future is inherently very uncertain, and therefore what you need is a system that can be resilient, make the financial system resilient. And there's no point blaming anyone for this, but I think that what happened around the world was that the evolution of China as a growing and dominant economy, injecting a lot of savings into the world economy, the phrase that Ben Bernanke used was the savings glut, started to bring interest rates down, especially long-term and real interest rates after inflation. And we should have realized that this was creating something that was wholly unsustainable. In a healthy economy, long-term real interest rates, like 10-year bond yields on inflation-protected securities, ought to be somewhere in the, 3 to 5% a year range. And you can't find any historical period where that really was not the case. And for 25 years, interest rates started at around 4%, 10-year bond yields, real interest rates, and they came down to zero. And that cannot be an equilibrium. And I think economists allowed themselves to be so obsessed with the models that they had created that instead of sitting back and saying, look, there's something wrong here, they just carried on with a traditional view that if you don't see enough growth, you cut interest rates. And so central banks in the West were cutting interest rates to boost domestic spending, and we were generating current account deficits, trade deficits, which meant that we were borrowing from abroad on a scale that could not go on forever, and in the end it didn't. And much of that was mediated through the banking system, so it was the banking system that collapsed first. That's one lesson. I think the other big lessons are that we took our eye off the ball of leverage in the banking system. That grew very rapidly in a period of 5 years. Nothing went wrong in that period of 5 years, but we should have been more alert to the fact that it was creating serious problems. I don't think we had thought through how we would operate the regime of lender of last resort. We assumed that we'd all read about it in the textbooks, and if we had a crisis, the central bank would act as a lender of last resort, lending to the banking system. But it turned out the banking system was completely different from the banking system that was described in the textbooks. Yeah. We can come on to that later. So these were some of the big lessons that I learned. But I suppose the only other one I'd mention, because I think it's relevant to the experience of the Fed, is that when there is a crisis, politicians will do everything they can to avoid blame, and therefore central banks are in an exposed position.
Yep.
And that's when it's very important for a central bank to keep its nerve and not get pushed into doing things which a central bank shouldn't do, like take big credit risk with its balance sheet, which are decisions which ought to be taken by elected officials. And if the central bank says, well, no one else is going to do it, so I will, then the difficulty with that is that after the crisis has gone away, the politicians will say, what was your authority for doing that?
Right.
And then they use this as an attack on cutting down the authority of the central bank. And you've seen some of that in the debate about Dodd-Frank.
So let's go through it. So in the aftermath of the crisis, there really wasn't the capacity for much in the way of fiscal policy in the Western world. And so central banks in the United States, ECB, Bank of England, did extraordinary measures, bought securities, quantitative easing. Do you think the central banks of the West went too far, did too much of it?
No, because I think that in late 2008, early 2009, what we saw was a collapse of confidence around the world, not just in the industrialized world, which had experienced a banking crisis, but actually in emerging markets which hadn't experienced a banking crisis. My opposite number in Brazil would telephone me and say, car sales collapsed in Brazil, but we haven't got a banking crisis. In India, the steel sales collapsed, but they didn't have a banking crisis either. And there was a real genuine loss of confidence, and world trade started to fall even faster than it had in the 1930s. So there was the prospect of a great depression again coming back. So I think central banks had to act pretty dramatically to head that off. Yeah. The problem was that I think that was ended by late 2009. I mean, the banking crisis, in my view, ended in May 2009 when the Federal Reserve and the US Treasury announced the stress tests of the banks and said, well, either the banks themselves have to raise capital or we'll put it in and take shares in return.
Right.
And that ended the banking crisis. But I think after that, central banks probably made a mistake in thinking that the sort of Keynesian downturn, which came about in late 08, 2009, maybe 2010, basically had gone away, but demand hadn't picked up. But that's because there was another major factor depressing demand. And in my judgment, that's because people came to realize during the crisis that the level of domestic spending in our economies beforehand had been too high.
Right.
And in part, that's because central banks were seeing that our economies were facing a structural trade deficit, the behavior of China in fixing its exchange rate, what was going on in the rest of the world meant that the US and the UK and some other European economies had a big trade deficit. Well, that's a drag on total demand. And if you want to maintain stable inflation and stable employment, you've got to get total demand to run in line with supply. And if net trade is being a drag on demand, you have to boost domestic demand so that when you subtract the contribution from the trade deficit, total demand is equal to supply. And central banks were very successful in doing it. But of course what they did was to achieve stability, but in an unsustainable way, because domestic demand can't run forever above the level of productive potential, because that is our measure of income. So what the crisis did was to bring home to everyone that we'd all been spending more than we could afford to in the long run. Yeah. So people cut spending. And that had to be filled by, that gap had to be filled by something. Export demand is the obvious thing.
Right.
Or some way of persuading people that their future incomes would be higher. What it wasn't was a temporary headwind, which of course is the language that central banks have come to use to describe the difficulty of generating a recovery. And I think the big mistake that's been made is if you misdiagnose the problem and say that the weakness in demand is just a temporary headwind, whereas in fact it's a permanent fall in demand, what you will end up doing is not just cutting rates and waiting till you see a recovery and then getting back to normal again. You cut rates, that generates a little bit of a recovery, but that peters out because the fall in demand is permanent. So you have to cut again. So you end up cutting rates until you get to zero. And once you got to zero, then in some ways I think only an economist can really believe that negative interest rates are the way to generate a recovery. And I feel that's where we are. There are some very good economists who think that if only interest rates could be minus 5%, you know, and in the model, that's true. We're so obsessed with models in economics, then that we get a recovery. But of course, if you ask people, you know, if Janet Yellen and you, Rob, were to announce in December that interest rates, far from rising, would be at minus 5% for the next year.
Yeah.
Although the economics profession would cheer and say, fantastic, you've done the right thing, now we're bound to get a recovery, most ordinary people would say, what the hell are these people doing?
So in the aftermath of this, so tougher bank regulation, that you and I have talked, tougher capital, stress tests, and one other thing that's happened, particularly I think worse in the United States even than the UK, but in both, is the household sector spent 8 years deleveraging.
Yep.
To where they actually have pretty good capacity now to spend, which brings us now to where we are. Sluggish recovery in both countries and other advanced economies. Unemployment rate declining, but still, and inflation targets, we're not making the inflation target, which we'll come back to, and sluggish GDP. And I guess I'll ask a few questions on this. There's now greater topics. We've had elections. We had Brexit then. In the context of that, we'll come back to the U.S. election. We'll start with Brexit because it happened first. And one of the things you and I have talked about is, and we see it here in Texas, but we have these rural towns that believe that their flat to declining population is due to global trade, which maybe some of it is in some cases, but we've also talked, some of it is due to overall deteriorating now demographics, aging demographics, where rural areas are at a disadvantage fighting for population. They're going, you know, to more populated areas. But so there's maybe a misdiagnosis, which some leaders have led and encouraged, that attributing it to trade or immigration, where it's really maybe disruption, technology-enabled disruption addition, and even just overall demographic declines, which are creating increased competition for population. So that leads us up to, though, despite that, Brexit. Why did it happen? And I know you've got views on maybe how the political leaders maybe could have addressed it versus the way they did.
So there have been a lot of comparisons between Brexit and President-elect Trump's victory last week, including some made by himself. But I think it's important to note there's one similarity I'll come back to. It's an important one, but in many ways they're completely different. In the US, you were electing a president who would have a major influence over the entire span of policy. The Brexit referendum was a very specific issue, membership of the European Union, and it was not a widespread referendum on government policy in general. Indeed, we'd had a general election a year before. The government had got a bigger majority, and the new Prime Minister, Theresa May, is of the same party. So this is not changing the government in any sense. But the issue was this very specific one about membership of the European Union. And I think that the two things that were absolutely incontrovertible that the Remain camp could do nothing about were, one, that European law, which could not be vetoed by the United Kingdom, actually had greater precedence in the UK than even domestic law. So the British Parliament was subservient to the European Parliament. And a majority of the regulations and laws that have been introduced in the UK in the previous years had come from Europe, not from the UK. So there was a genuine sense of take back control. So that the Trump slogan here was Make America Great Again.
Yeah.
In Britain it was take back control.
Yeah.
And there was absolutely no argument that the only way that Britain could be sovereign again was to leave the European Union.
Yeah.
And of course the European Union didn't look to be a terribly successful operation. The second issue was immigration.
Yeah.
And the attitudes in the UK, I think, are definitely different from the ones that you described. the areas that voted most strongly against staying in the European Union were areas where immigration was very obvious. Whether temporary, coming in to take jobs of temporary agricultural workers in the summer, or permanent in the sense of the industrialised towns of people coming in and moving in there. And it had altered the atmosphere, the impression that people who lived in certain communities, that community in which they'd grown up, had changed totally during their lifetime. And of course the political class in London, you know, for them, having lots of Polish builders and Polish cleaners, it was a great boon because they got their building works and their cleaning services done more cheaply. If you happened to be an English builder or an English cleaner, it wasn't such an obviously good idea. And just to illustrate how important this is,
so immigration was much more prevalent, sounds like, in many cities in UK than it's been here.
I grew up thinking that population growth and the growth of the labour force would always be higher in the United States than in the United Kingdom.
Yeah.
The reverse has been true in recent years. Our population and labour force have been growing faster than yours. And that is entirely immigration. I'll give you a small example. And it's not that the UK is against immigration, but the problem in the European Union was that there was no ability to control it. None at all. And to give you an example, if I were to ask, you know, many people here, you think back to the old traditional relationship between this country and the United Kingdom, you might expect the biggest religious denomination in Britain to be Protestant and the Church of England. It isn't. It's the Catholic Church. Why? We have 1 million people from Poland living in England. They are very devout Catholics, and they go to the churches. Indeed, they now have to provide a lot of the clergy and the priests for these churches too. So there have been profound changes. Now, people have said not against immigration, but what was absolutely clear was that the government that had promised that it would control immigration did not do so. Immigration actually went up rather than went down. And it was obvious they couldn't control immigration because there was absolutely no way that they could do anything to control the numbers coming in from the rest of the EU. So I think these two issues made it pretty clear to people that when the political class said, oh, if you worry about immigration, you must be racist, or if you worry about losing jobs, you must be xenophobic, then people felt they were being talked down to. And I would say if there's one similarity I've noticed between the debate in the UK and the debate here, and you see it in London and New York, absolutely, it's that the metropolitan elite feel that in both cases, how on earth could people have voted this way? This is surely unthinkable. These people really are deplorable. And of course, once you let on that you think a lot of other people are deplorable, you don't have much chance of winning their vote.
And you felt, you and I have talked about this, you felt Cameron, and we'll come back to the US in a moment, but Cameron, for starters, gave that talk down to people, made them feel he wasn't sensitive to what their concerns were.
I got to know David Cameron reasonably well. I like him a lot, and George Osborne. I worked well with them, and I admired them for what they'd done.
Yeah.
David Cameron in particular was very statesmanlike for his whole time as Prime Minister, with one exception, which was the campaign, the referendum, to whether or not we should stay in the European Union. And why do I say that? Because he himself had serious reservations about the European Union for most of his political career. And yet when the campaign started, the argument was, you'd have to be an idiot to vote to leave. Well, that was clearly not true. Then we were all told it would be exactly £4,330 worse off if we were to vote to leave the European Union. How could anyone possibly know that? I mean, ordinary people may not have a PhD in economics, but they do know when people are exaggerating. And this was one of it. And then we were told that there'd have to be a special emergency budget to raise taxes and cut spending if we voted to leave, because there'd be a recession. None of that made any sense either. So in the end, I think people felt that he was a metropolitan elite, not taking them seriously, not giving them thoughtful arguments. I think if David Cameron had said, there are arguments on both sides, but my advice as Prime Minister is that the future of the European Union is highly uncertain. It may look quite different in 3 or 4 years' time. It may be that we'll want to stay in it if it changes it in our direction, or it may be at that point we'll decide to leave. But this isn't the moment to take a leap into the dark. But the argument was never put like that. It was basically the equivalent of the deplorables.
Right.
And it backfired very badly.
So what's going to happen now? If first the UK and then in Europe, what do you think the impact of this will be? And do you think more countries will follow in Europe?
No, I think not. And I think so let me start with the European Union. The European Union, I think, faces 2 existential problems, and they are serious. One is the monetary union, where I don't think it's working. I think it's been a disaster. And I don't think there's any real prospect of having rapid economic growth in the European Union while monetary union persists. And they have no answer to this at all. And you can see Mario Draghi at the European Central Bank desperately trying to come up with new ideas, new suggestions. Latest one as a finance minister for the monetary union. But no one in the rest of Europe wants that. The other is immigration, where the principle of the free movement of people within Europe was a fine principle when you were just thinking of people moving from amongst a small number of European countries to other countries.
Yeah.
But it came under pressure when the Eastern European members joined the European Union, and it's come under intolerable pressure when 1 million or more people want to come from outside the EU into the EU each year. And you can see that de facto the Schengen area, where there's a passport-free zone within the European Union, has been abandoned as people have been forced to put up controls and barriers to prevent illegal immigrants being shipped on from the first country they arrive at to somewhere else in the EU. I think they have no answer to these questions at all. But what is not an existential problem for the EU is British membership.
Yeah.
So I don't think it's, if you look at what happens in Italy or France in their upcoming elections, the people who vote for Five Star in Italy or Marine Le Pen in France, they don't go home in the evening and say, darling, I was very impressed by the vote in Britain, and I do wonder whether we shouldn't sort of do a vote in a similar way here. They vote according to domestic conditions in their own countries. So I don't think that Britain leaving the EU will actually have much impact on what happens in the rest of the EU. The EU, I think, has serious problems, but I don't think they're affected one way or another by the UK staying in it, which was precisely why the UK was actually not having a lot of influence on the rest of Europe. Now, in terms of the UK, I think the situation in some ways is relatively straightforward. The Prime Minister said, and this was a fairly obvious thing to do, that there'll be a bill to repeal the European Communities Act of 1972, which is the the act under which we joined the EU. We'll repeal it, but then immediately have a very small bill, short bill, to translate all existing legislation that we adopted under that directly into UK law, so that Parliament can take its time to decide which of the legislation we've adopted in recent years we want to keep, or to get rid of, or to have another domestic debate about. But it will be the UK Parliament that decides that. The next point is, and this is now the urgent priority, the government has to come up with a UK immigration policy. One of the big problems we face is that neither side in this referendum debate seem to have made any preparation whatsoever for the outcome that occurred. So that they don't have an immigration policy, and they've got very quickly to come up with one. And that can't be negotiable. That's a British policy. The rest of Europe will have to come to terms with it. And then when it comes to trade, I think, it's a lot simpler than some people would suggest. I think there are 3 groups of countries that matter. The first are countries outside the EU, but with which the EU has a trade agreement. And we go to those countries and say, look, when we leave, why don't we just roll over the treaty we've got with you already by virtue of our membership of the EU and just carry it on. Second group of countries again outside the EU, but with which the EU itself does not have a trade agreement. We go to them and say we'd like to have a trade agreement. Either we get one, in which case fine, we're better off, or we don't, in which case we've got the status quo again. And the third is obviously the rest of the EU, where we all have to negotiate with them. But there's a good cop and bad cop routine here. The bad cop will be all the European institutions,
right,
particularly people in Brussels. The good cop will be politicians around the rest of Europe, including in Germany once their elections next autumn are out of the way. And they'll be very much influenced by the fact that the UK has a very large trade deficit. Now, there are not many circumstances in which having a big trade deficit is a good idea. But it's just when you come to negotiate a trade agreement, it is a good idea because the other countries depend more on the trade than we do.
So let me ask you, there was great fears that there was going to be a deep recession in the UK. Hasn't turned out that way so far.
Yep.
Why not? Why has UK performance been better than has been feared?
Well, I think the fears were exaggerated. I mean, the first thing to notice, and the obvious point, nothing's happened yet. I mean, we won't leave the EU for another 2.5 years. So, I mean, it's not clear why anything should have happened significantly.
Right. Okay.
Secondly, the plausible argument was that there would be a downturn in overseas investment in the UK as foreign companies affected by the uncertainty just hedge their bets. And we may see some of that. Probably a bit early to judge it yet. We may well see some of that. But the third thing which has helped to offset it is that the exchange rate of sterling has fallen. That's already had some beneficial effect on.
So the central bank action too, you feel has been
well, I think it's not clear whether they needed to do everything that they did.
Right.
The exchange rate was a market-led response.
What happened with the
now? Of course, the irony is that almost everyone regards this as a judgment on whether Brexit's a good idea or not. Actually, the strange thing is that the fall in sterling that occurred immediately after the referendum merely unwound a wholly undesired appreciation of sterling in 2014 and 15. So the exchange rate after the referendum was exactly the same level as it was on the day I left the Bank of England in the middle of 2013, which we thought was necessary to reduce our trade deficit.
All right. So let's talk about one other thing, then we're going to take questions from the audience here. There's been a lot of discussion in this country of late about a lot of issues, which we'll get into as we get into more, but one of them is about Dodd-Frank bank regulation. And obviously we've been advocating here, by the way, small and mid-sized banks should get substantial relief because they're not systemically as risky. But there's been even discussion or suggestion that maybe even on big banks there would be a change. What's your view on what's an appropriate way for us to think about bank regulation here and in the UK and in Europe from here?
So during and just after the crisis, it seemed to me pretty clear that what we had to do was to move to a point where the leverage of the banks was a lot lower than it had been before the crisis. And of course, banks themselves were trying to reduce the leverage.
Right.
And going forward, I would like to see a relatively tough, simple leverage ratio. But I do think that what we've actually done in practice, and I understand why the regulators have done it, but I think it's unfortunate, is that people have been trying to demonstrate that if the same thing that happened in 2007-8 happened again, that every single detail of that is now closed off. So what we've done is to create massively detailed regulation that will almost certainly be irrelevant for the next crisis, which will be rather different. And I think the only way to sensibly to regulate the banking system is not to burden it with such detail that, I mean, certainly in the UK, in London, I'm amazed now that you talk to people in banks. They feel they can't do anything without taking the advice of their compliance officer first. That is not the definition of healthy regulation.
Yeah.
That's excessive detail. I mean, one simple example, in the Bank of England now, it has to approve the chief executive and the chairman of a bank, okay? But then it interviews and has to approve a whole raft of people below that level before they can be appointed. Well, if you've approved someone to be a chief executive of a bank, why don't you trust him or her to make the right decisions about the people they want to employ?
So your advice, tough total capital, still stress tests, but otherwise simplify the rest of the rules.
Absolutely.
Right? And let them operate.
Yep.
Okay. Let's take questions from the audience here and we'll weave in a few more. Fire away. Yeah, please.
Robert Dyke from American. Given the fact we have extraordinarily low interest rates right now and the U.S. expansion is fairly long in the tooth, what would you do if you were in charge of the Fed, if we hit another recession, what arrows do you have left to sling? What policy prescriptions would you advise?
So I think the first general point I'd make is that I think all central banks now would be well advised to say, look, we did extraordinary things in the crisis. We kept it going. Monetary policy can buy time to enable other policymakers to put in place the measures that are needed to generate a sustainable recovery, but we really can't do any more. So I would put a floor on any further monetary stimulus and say that we have to find a way back to higher levels of interest rates. Now, if in the meantime another downturn hits us, then I think the right thing to do, since there isn't much room to cut interest rates, would be to just increase the level of asset purchases. But I wouldn't expect a lot from it. And I think the message from central banks ought to be, look, we would like to get back to a point where interest rates are at a level from which we could cut them if there were a further downturn. But the reason we're stuck where we are now is not the conventional post-war business cycle phenomenon. It's this permanent fall in domestic spending as people have come to realise they spent too much before. And we better tackle that problem at its roots and deal with and diagnose that problem correctly. Central banks can't be the solution to that problem. So I think it's a mixture. If I were now there, I've been trying to make as many speeches as I could, saying that central banks cannot be the answer to our current predicament. Don't look to central banks. Other policies are necessary. And we hope that before the next downturn comes, we'll have got interest rates back to a level from which there would then be some room to move.
So we've been, as you know, we've talked calling for broader economic policy at the Dallas Fed, that is. And I gather if you were in the UK, you'd be doing the same thing, yes. Encouraging. What type of broader policy would you, I know as a central banker you want to be careful, what types of policy options would you encourage other policymakers to be considering?
So I think there are three sorts of things that I think are important, only one of which I think is within the domain of our current policymakers. I think on the supply side, I really would think, and maybe there is some prospect with the new American government, that who knows what will come out of it, it's far too early to judge. But what it's done is to shaken up things a bit. And that means that maybe people will think more imaginatively about the kind of supply side changes that will be made. I mean, they've got to be sensible ones. But I think that an attack on supply side reforms across a wide range of areas, I mean, tax reform I think is one, particularly in the area of savings and investment. Education is another, very clearly. I mean, if we're going to deal with the concerns of people who feel they've been left out by prosperity as a result of globalization, leaving them behind, the jobs that they were brought up to do that don't exist anymore, that's always going to be the case. Education retraining is a fundamental part. I think I'm very worried about the impact of the current level of interest rates on the viability of pension funds and insurance companies, and just as worried about young people deciding, well, it's not worth bothering to put aside money for a pension. So I think there's a whole range of things that can be done in this area. The second I would focus on is trying to find a way, and this is the one area where I would criticize the US administration internationally in the last 8 years. I think that they have put far too much weight on trying to keep the monetary union in Europe together. And they put pressure on Germany to put a bit of money in. They're doing it again now this week, give Greece debt relief. Well, I mean, Greece will have to get debt relief, but that isn't going to be enough. The monetary union, by leading countries like Greece to have a vastly overvalued real exchange rate, and countries like Germany, a very clearly significantly undervalued real exchange rate, this is not a sustainable position. So I would try and find ways of introducing exchange rate flexibility, not just into China and Asia, but into Europe as well. Yeah. And the third is international cooperation. And this is going to be the hardest of all. I think the problem at present is that most countries in the world could genuinely say today, if only the rest of the world was growing normally, we'd be fine. But since it isn't, we aren't. And so countries are tempted to say, so what can we do on our own to get out of this trap? push down the exchange rate. Well, that's clearly a zero-sum game. So we've got to find some way of creating a positive sum game at the level of the world. The IMF ought to be able to do it, but I worry that it's become so political because of its relationship with Europe that we find it very hard to do.
What about infrastructure spending?
So infrastructure spending is a good idea, subject to two levels of concern. The first one is some people have described the proposals of the new president as a sort of Keynesian injection. The trouble is we don't face Keynesian unemployment, and the unemployment rate's down to 5%. So if you have infrastructure spending, it's going to crowd out some other form of spending.
Right.
What is the other form of spending we think is less deserving? That's not obvious by any means. And the second thing is that it really ought to be something which is financed by government, because infrastructure spending, such as can you turn JFK into Dallas Airport, is A, not going to be cheap, and B, is going to be quite difficult to finance privately, I think. So these are the projects we need to pursue and plan, but you can't just switch it on like that.
But if we could do private financing, you'd welcome private sector. For example, a lot of these airports have been turned into shopping malls, in effect. If we could find a way to use less government money, more private money, you'd say good or bad?
Well, there's still a problem that if the answer is let's do lots of investment in infrastructure, it doesn't matter who's financing it, some other spending gets crowded out.
Okay.
And I'm all in favour of the private sector, provided it's a genuinely private sector project. What I am very unhappy about is what's been done in the UK and elsewhere, called the Private Finance Initiative, in which the private sector finances a project and the public sector then runs it. Now, what's bizarre about this is that it's completely the wrong way round. We know the public sector can raise money more cheaply than the private sector, and the private sector can run things better than the government.
Fair enough.
So why do we do it the wrong way round? I don't know.
Okay, please.
On a lighter note, amidst all the chaos, was there ever a moment of humor?
There was a lot of black humour. And there were certainly some surreal moments. One I've never forgotten was the G20 meetings, which we went to a lot of G20 meetings. Most of them were completely pointless, but there was a G20 meeting that was going to have some value in the spring of 2009, and it was in London, and Britain had the presidency of the G20. And in the way of these things, Angela Merkel decided that she wanted to have a sort of pre-G20 summit meeting for the European members of the G20. So there was some Sunday when we all had to fly to Berlin to the military airport, all in great secrecy, for a meeting with the other European members of the G20. So I was told on Sunday morning to report to the military airport in London and await the plane. And I got there and was met by a Treasury civil servant. It was a small delegation from each country, the Prime Minister, Finance Minister and the Central Bank Governor, and maybe one person each with them as their staff. So it was a small group. And I got there and the Treasury official said to him, "I'm terribly sorry, Mr. King, to tell you that the plane we had hoped to use of the royal flight is no longer available." Being commandeered for golf or some other purpose, I suppose. But anyway, but don't worry, we went on the internet and we have another plane which is coming to pick us up. And it was to pick up the Prime Minister Gordon Brown from Edinburgh, fly down to London, pick up Alistair Darling and myself and go on to Berlin. So this plane came in, and as it landed, I could see it was quite a small plane. And as it taxied up to the building where we were standing, to my surprise, on the fuselage were written the words, Tyrolean Airways. And they'd got a plane from Tyrolean Airways in Austria that had come to pick us up. And it had a very nice Austrian air hostess who was wearing Tyrolean national costume. And she served us Mozart Kugel chocolates from London to Berlin. And as we landed in Berlin, we could see there were two massive jumbo jets also on the tarmac. One had the French tricolour on the tailplane, and the other was a Spanish government plane. I don't know why the Spain was there, because they're not in the G20, but anyway, they'd been invited for some reason. And you could see their delegations standing waiting for us to arrive. And as the air hostess lowered the rather rickety steps down which we had to climb to get down, I could see Nicolas Sarkozy, the French president, looking with complete disbelief as we walked down these steps, and the British delegation then turned and waved goodbye to this air hostess in Tyrolean national costume. Sarkozy was obviously saying to himself, I knew the British, were a bit strange, but not this strange.
All right, let's take other questions. Yes, sir.
Do you think Donald Trump should appoint to Secretary of Commerce and Secretary of Treasury?
Oh, well, I wouldn't dream of suggesting to anyone in this country, whom of the very many qualified people, I'm sure there are to appoint, if they're willing to be appointed. So there is a process. I was saying to Rob before, the one thing I think should happen after all elections is that there should be a compulsory holiday declared, and the victor cannot make any decisions for at least a week, if not 2 weeks, and they'd be forced to take a holiday before any other decisions are taken.
Let's take this one.
In the financial crisis, the derivatives that didn't clear through an exchange were a big problem. Is there a mechanism in place that may prevent that from happening?
Well, the US Treasury led, I think, quite a successful movement across the world to try to get derivatives, as far as they could be, cleared through central clearing houses. And that has certainly done a great deal to ensure greater safety of derivatives. Of course, it's done it by creating clearing houses which themselves, if they were to fail, would be very problematic. And so I think there are some quite tricky questions about how clearing houses should be regulated and how much capital they need to have, and whether, in a real crisis again, whether they might end up being the institutions that we bail out. So I still would worry about the scale of derivatives. And the thing which, two things have seared in my mind. One is a moment when Alan Greenspan came to London to open the new building for the Treasury in London. And he gave a speech at which he talked about many of the potential benefits of derivatives, because these were being held by institutions that could decide if they wanted to take the risk. And so the market was distributing risk to those best able to bear it. Well, I'd rather think that, in the crisis itself, maybe it was another lesson of history that we'd rather forgotten, is that people do not think back to the long sweep of history, and they get carried away, and that many of the derivatives were held by people that were not in a good position to bear that risk, and it came home to damage us. And I think we still have to worry about this, because the second thing I remember reflecting on derivatives and being worried about is that if you take the basic ways that companies or banks used to finance themselves, equity, bonds, deposits in the case of banks, or short-term borrowing in the case of companies, now what we've done is to create a whole superstructure of complex derivatives on top of all this. And there's no limit to the amount that you can create in this superstructure. The basic methods of financing have to be related to some sense to the real operations of the companies or banks. And I used to talk, the analogy I use is that in Washington Square in New York, there are a small group of elderly men who will play chess against all comers for $10. And you can watch this game of chess. And there's only $10 at stake. But just suppose all the Wall Street bankers were to come up to Washington Square and stand around this game and start taking bets on it and creating all kinds of CDOs and all sorts of acronyms of instruments defined on the outcome of this one chess game. And the reason why that's important is that in 2007, when we learnt that subprime mortgages in the US might generate losses, all the regulators around the world were asked the question, are the scale of losses big enough to bring the financial system down? And the answer was very clearly not, because it was too small. It was like these people playing chess in Washington Square. But all of that, of course, ignored the fact that on top of the basic contracts themselves a whole host of derivative contracts had been built without limit. And it was that created the uncertainty that made people unwilling to lend to any bank.
So just to amplify that, and I'll ask a question related to it. So I think our best estimate I've seen is there was 10 trillion of debt outstanding on the planet. There was 90 trillion of credit default swaps to insure that 10 trillion. And I don't think anybody saw it because it was netted on most balance sheets to zero unless there was an extreme event. And then all of a sudden you realize, the question I always ask now, and I'm curious your opinion, do the stress tests of the banks and major financial institutions, are they sufficient, do you think, to get at this counterpart exposure today?
It's very hard to judge because one of the hardest things in devising a stress test is to think about the stress that you're testing against. And the real problem is that you can think of a stress test, like Spain or Greece leaving the monetary union. The hard thing is to know what the knock-on consequences would be, which would then exacerbate that stress.
Okay.
And I think that's the thing that's very, very hard to judge. And so if you go too far and say, what happens if the world financial system collapses? Well, we know there's not enough capital.
That's too tough,
But that's too tough. So I think the hard thing is it's very, very difficult to be confident that you've got a stress that's you can always insure yourself against.
Okay. So two last questions to wrap this up. We've had, up until this period, sluggish global growth, aging demographics. It's true in every advanced economy. Even China, with higher growth, has a severe demographic problem, and they're using leverage to grade it. And we've had surprisingly low inflation. It appears, and we'll see how the cards unfold next year or two, that there's maybe forthcoming some broader economic policy, fiscal and otherwise, to get out of this. What advice would you be giving to the Fed from here as we watch all this unfold? Any particular advice or caution or wisdom we should be particularly attuned to as we go through this next phase?
Well, I hesitate to give advice, particularly since you will be voting from January.
But do it anyhow.
So I think if I were to give advice, I think I'd say central banks should now make it very clear that they can't really provide any more support. Mm-hmm. So we have to be on a path of gradually trying to remove the stimulus that we've given in recent years. Mm-hmm. The hopes for recovery have to rest now on other policymakers. There are a range of different policies, and not for the central bank to say what they should be, but they need to be thought through very carefully. So it's easy to say infrastructure is a good thing, and indeed there is obviously bipartisan support for infrastructure. But as both Marty Feldstein and Larry Summers have made points in recent weeks, infrastructure should not be carried out simply in order to reduce unemployment even further below what may well be a natural rate of unemployment.
Right.
And it doesn't make sense to create artificial ways of financing infrastructure investment merely in order to keep debt off the public sector balance sheet. If there's a good argument for infrastructure, issue government bonds and finance it. The problem facing the public finances in the United States is not a short-term problem, it's a medium-term, long-term problem. And I think, as Marty Feldstein talked about in the Wall Street Journal today, one thing I think can be explained to people, and it can be something that's understood and accepted, is that all our pension schemes need to be modified to say we're living longer, and as life expectancy goes up, we must share the benefits of that between working life and retirement. So the age at which we qualify a pension has to keep rising. And this should be built into our pension schemes, both private and social security. Right. And that will be one way to make a big dent in the prospective future deficits that will be faced. And I think there's a whole range of these policies which, this is trying to take advantage of what's happened in the election.
Is it okay for central bankers, is it appropriate or inappropriate for central bankers to lay out at least the policy options, or should we not even be going that far?
I think it makes sense to set out the areas in which progress could be made, and to say there are choices in each area,
Yeah.
But don't look to monetary policy now. Look to these wider set of policies. And please, Congress, don't try to push off responsibility. You've got to take responsibility now. They're your choices, but these are the areas, for
Good.
example, in which we can make progress.
Good. Thank you, Lord King. Let me turn it to Mark Wynn.
So